What's up, people? We're back again. Welcome on my YouTube channel. My name is Clifford Malauzi. In today's video, I'm going to be teaching you how to perfect your entries every time you want to take a trade. So remember to like this video, subscribe to my YouTube channel if you find this content valuable. Also, remember to hit the bell icon so that you can always get notified every day I post a new video. Let's get started. So when you say entries, it's just simply you hitting the buy and sell. But the most important thing in Forex to master is to know when exactly to buy or when exactly to sell. So in this video, I'm going to be showing you exactly how you should be able to take calculated entries and stay away from the garbage and minimize the chances of blowing your account. Just because the trade is moving up doesn't mean you can just enter anywhere. You have to know exactly where you're supposed to enter a trade. Right? What you're seeing in front of you are two types of entries. We have a risk entry and we have a confirmation entry. And I'll explain a risk entry in details, and I'll also explain confirmation entry in detail. And I'll give the advantages and disadvantages of each so that you guys should know exactly the pros and the cons of using either of these. And by the end of this video, you'll be able to know where exactly to position yourself. The risk entry is just simply you entering the market with just one confirmation. And this confirmation is always your order block. It's either you have your order block here, your demand area, or whatsoever. It's just like you have one confirmation that will tell you it's a buy. Of course, you might also have things like a break-off structure on the side. You might have a Fibonacci in place that you have used. You can say, okay, this is like in the 70% or in the 80%. You can say you're having your order block down here or demand zone, just like that. Or you can all have all that, but then all you know is that the minute price comes in my demand zone, I'm going to be buying. In so doing, when we are looking at this thing, you only use what we call one confirmation. Okay, we have used the multiple confirmation, yes, because in both, we're going to use a lot of confirmations. But then to enter the market, we are using only one confirmation, which is the order block. So we can say as soon as market comes in this zone, we're going to enter a trade and we're going to be pushing to the upside up until the market hits our TP. So now let me come on confirmation entry. So confirmation entry, this is quite different because then we're having a break-off structure right here. We're having a demand area. You should be looking at this maybe on a 15-minute time frame, 1 hour time frame. But when it comes to entries, the minute the price comes in your order block, you're not entering, you're not doing anything. What you're gonna do, you'll simply go on a 1-minute time frame and you're gonna zoom. So when price comes on a 1-minute time frame like that, what you're gonna do is you have to wait for the price to engineer liquidity on a 1-minute time frame. So engineering liquidity is simply allowing the market to consolidate inside your order block. They can consolidate outside or inside. In as far as price has tapped in your order block, that's okay. So in this case, you're gonna realize that the market is simply creating equal lows that have later been grabbed, like you have seen down here where we are seeing the market grabbing these lows as liquidity, and then price is also gonna grab the upper side just like that as liquidity. Price taking away all this liquidity has been grabbed on the downside, and then liquidity has been grabbed on the upper side. The next thing you do is to take a Fibonacci. Once you bring it from this low to his high, focus on the areas that are in the 50%, right exactly right here, and that's where exactly you'll be taking your trade. This is where exactly you'll be putting your stop loss. For you to be able to use this strategy, you need to understand first things about liquidity. It shouldn't be new, as I've explained about liquidity being grabbed on both sides. If you don't know anything about liquidity or demand zones, I would advise you to subscribe to my YouTube channel and check the previous video that I've made on these topics so that you should be able to follow up. So you can see price push all the way to the upside and you'll be able to make your profits. Now, I want to show you the differences between the first and the second. The first one is we are simply just entering the minute the market comes in this area. We're not considering anything. The second one, we are simply considering a number of factors, including liquidity being grabbed on a smaller time frame. And trust me, guys, in as far as you pay much attention, you're gonna see this thing happening every single time. So wait for this confirmation to show up before you take your trade. So right now, I just want to show you like we are taking the same trades, but the trades are quite different when it comes to the RR. So let's see. On this trade, we are taking a trade, and our RR, this one is a 1 to 10, which is quite nice. If you're risking 1%, we're gonna make 10%. This one you're only targeting 6%, just because you may not be certain on where to put your stop loss. You can actually put your stop loss right here, and then ended up being stopped out, and then all that. And for you to be safe is to put your stop loss down here, which means you'll be risking more money than someone else who is also on the same trade but is risking less. The reason why we want to see liquidity being grabbed both sides is because we want to see where to put our stop loss. Another second thing is when it comes to the psychology of a trader, trader. A trader is less emotionally attached to this kind of setup because you exactly know where your stop loss is going to be. And even if your stop loss is violated, even if the market hits your stop loss, you're gonna be cool because you know exactly what you did. You followed everything. Your mindset gonna be in a good state because you already know and you trust the setup and you trust everything. Whilst in this case, you're not certain, you don't know exactly, because you might see the market coming down here, you think of closing, you're going to react differently just because you're uncertain what the market might do. But by the end of the day, it might be right because the market will still go up. Now, let me talk about the good thing about risk, and you never miss a trade because the minute the market just comes in a zone, you're already inside the trade. Whilst confirmation entries, you might end up missing a trade. Let's say the market reverses right before it reaches your 50%. It means if you're waiting for market to come in the 50%, you're likely to miss out this great opportunity. The trade might miss you out and you might cry like a baby. So you don't have to cry like a baby just because the trade has left you. But don't worry, because those things are gonna happen. The best thing you can do is just to make sure that you are available every time these things are happening. That's like the flow for the risk entry, because no matter what, in as far as that trade is correct, you are always correct. So I'm pretty sure you guys are following and enjoying this lesson. Don't forget to like and subscribe to my YouTube channel for more content like this. And right now, I would like to take you on the chart and show you these things, how they work exactly on the chart. You're gonna spot these things mostly on a 1 minute time frame. So a very good example is right here, where we are seeing an order block where price has to come trade in this area and then continue pushing to the downside. So in this scenario, this is our point of interest, and what we are seeing on the first go is price area and then coming up. So what did the price do? They actually price come and then printed a high. And then what happened to that high that was printed? Price grabbed liquidity. So right now, we're not simply just because price has come in this area, we're supposed to enter a trade. No, we're supposed to wait for price liquidity to be grabbed both sides, and then we should be comfortable to enter a trade. So right now, we're seeing that liquidity has just been grabbed up here, which is a nice thing. And next, we're seeing that on the lows, liquidity also got grabbed. So after liquidity being grabbed on the downside, we are seeing these lows coming here to grabbing liquidity on the downside. Now we bring what we call a Fibonacci. We bring a Fibonacci in this area all the way to the downside. Remember, guys, we are focusing the 50%. So now we'll take our trade and we'll enter our trade the minute the price comes in the 50%, and our stop loss is always going to be on this high, and the trade will push to the downside. I don't know how far did this trade go, but when we have our stop loss down here, it's gonna be far much better. Let me just see how far this trade go or went down. Yeah, so it actually went so big to the downside, which is really, really amazing, and which is really, really crazy and good. So you can actually see, guys, this is a very good trade. Let me also just, let's get to this level and see how much this trade was worth it. So it is actually a 1 to 15% reward ratio. So imagine somebody was ending the same trade with their stop loss above here. It's actually like half the percent, which is like 7.3% reward ratio whilst taking the same trade. So the whole essence of making this video is just to make it clear for you that a confirmation entry is quite good because it actually perfects your entries. You're going to minimize your money. Everything is just going to be like on point. Let me know if this video has been very helpful. You can actually backtest it on any pair. These things are happening every single day. The only thing that you need to focus on is to find something that will look like this, where liquidity has been engineered and then liquidity has to be grabbed. After, that has to be grabbed on the other side and then come on the 50% of the Fibonacci, and then you enter a very good sell, you drop to the downside. Same thing when you're going to the upside, you just have to see price coming in your area and then creating liquidity where liquidity has to be grabbed both sides. After, you have to come in the 50% and then have to continue going down. Going up. If this video, guys, has been very helpful, consider liking this video and hit the like button, and let me know what you think about this video in the comment section, and let me know what more videos can I make on the same topic. Otherwise, thank you guys for watching my video. Let's meet in the next one, and I'm happy that you are enjoying these videos. Goodbye.